Good morning. Why 2026 could be a buyer's window in Houston commercial real estate. And here's the direct answer. 2026 may offer a rare buying window in Houston commercial real estate because of pricing pressure, maturing debt, cautious lending, and motivated sellers could all align before capital fully re-enters the market. Now, for disciplined investors and business owners, that combination can be a winning opportunity. And as a commercial broker and a capital markets advisor in Katy, Fulshear, and West Houston, I'm watching several signals fairly closely. And here's why 2026 may reward strategic buyers. First, debt maturities are forcing decisions. So between 2025 and 2027, a large volume of commercial loans will reset. And many were originated during low rate years. Now, what this means is that refinancing today is going to mean a little bit lower leverage, potentially higher debt service requirements, and could it require additional equity injections to keep the loans performing under the new standards, that is. And there's going to be a stricter underwriting focus with specific focus on the debt yield of the instruments. And when owners cannot refinance at prior terms, they're going to really face three simple choices. A, you need to inject capital. Or B, you need to sell. Or C, you need to bring in equity partners to keep the deal moving. And that pressure can create pricing flexibility, particularly in office assets or secondary retail, and as well some certain value add industrial assets. Number two, Houston office stress is creating some spillover. Now, Houston's office market has experienced some elevated vacancy and repositioning pressure recently. And while Class A trophy assets remain competitive, older products are continuing to adjust. And why this matters? Well, some office owners may reprice meaningfully. It could open up the door for some adaptive reuse opportunities to emerge. And lenders are more conservative in the office space right now. And even investors who don't buy office can benefit from the pricing psychology resets that are across all asset classes when one sector is going to reprice. So it's a mindset, a hive mind. Three, industrial and retail remain strong, but there's selective opportunities. And Houston industrial fundamentals remain particularly resilient, especially so near I-10 West and near the Grand Parkway, but also in port adjacent corridors, as well as retail and high growth submarkets like Katy and Fulshear that continue to perform due to the population growth and rooftop growth in the area. Now, it's interesting to point out that buyers are no longer overpaying blindly, too. And what that means is the cap rates have adjusted upward in many segments. And how we see that in the market is we see more realistic valuations. You'll see a little bit less bidding war frenzy and better underwriting discipline on the buy side. And in short, strong assets will still trade, but pricing is becoming more rational again, is the point. Number four, debt markets quietly set the prices. And commercial real estate pricing does not move independently of credit conditions, this is a big takeaway. And when lenders tighten on specific items like debt yield or their DSCR requirements or their overall loan to cost that they're willing to offer, particularly if they're offering recourse versus non-recourse, values will follow because they can tone down the investor pool. But if rates stabilize or gradually compress in 2026, which is likely going to happen, buyers who acquired during tighter capital conditions may see some upside compression later. So buy now, make money later. And the opportunity window often exists before the rate cuts and not after. So this window between now and June is a good time. Five, Houston growth story is still intact. Despite capital market volatility, Houston continues benefiting from the energy sector stability, from the port expansion, but also from manufacturing and logistics demand and West Houston's population growth, but also the infrastructure expansion along the Grand Parkway. And Katy and Fulshear, in particular, continue absorbing retail, medical, flex, as well as industrial demand. Now, the fundamentals remain, and pricing may temporarily soften, but that's the window, is the point. So, number 6, what smart buyers are doing right now. Now, strategic investors are looking at properties and stress testing DSCR at conservative rent assumptions. They're targeting motivated sellers with clean terms, and they understand their debt yield first and their LTV second. And in doing so, they've been preserving liquidity for the past 12 to 24 months. And what that does is it aligns up acquisitions with a longer hold, so 5 to 10-year holds. And these folks are not speculating on rate cuts. What they're underwriting to is today's reality right now. Number 7, who this window is for. Well, this potential 2026 buyer's window is going to favor 1031 exchange investors first, but also owner-occupant businesses, industrial investors, medical office buyers, as well as value-add retail investors. And in general, most long-term CRE holders. So if it does not favor highly leveraged short-term flippers is the point. People are buying on fundamentals for the long term. So the final thought for the day is that buyer windows rarely feel comfortable. And they often can show up when capital is cautious, but also when sellers are realistic, but also when headlines are uncertain. And Houston's long-term growth trajectory, combined with some short-term capital pressure, may create one of those pressure moments in 2026. And the point here is that preparation is going to beat prediction. So if you're evaluating your acquisition strategy in West Houston, Katy, or Fulshear, now's the time to model some scenarios and not wait for headlines to declare the opportunity for you. That, my friends, is it for the day. Please visit HoustonRealEstateBrokerage.com to figure out how to get a hold of me. Love to talk to you more. Take care.